So in our last video we talked about the candlestick, the most important thing in the chart. Yes, the candlestick shows you the story that the market is trying to tell, helps you understand market move, market momentum, market direction and all that. So people were like, what moves the market? Why is the market trending up? Why is the market trending downward? So this video is going to help you understand why the market is moving in this direction or that very direction. So first off, we are going to start with why do the market move? Who moves the market? What possible actions can cause the market to move downward or upward? So we have like about four of them. Yeah, basic four things that move the market. So first off is the big banks. Yeah, central banks. Now literally when the central banks increase a currency exchange rate, price is seen to either go up when it increases. Let's say for example GBP USD exchange rate increases. So GBP Central Bank of London, let's say they increase the rate of GBP, the exchange rate. So GBP is definitely going to be bullish for that period of time. But if the Central Bank of the USA increases the exchange rate of the dollar, GBP USD is going to be bearish. Now you see why the market is moving, because of the change in exchange rate. Change in exchange rates affect the direction of the market. Market can suddenly move 100 pips during this whole scenario, during this time, during this period. Market can move 100 pips. Market can just move in one direction very quickly, unexpectedly. So second thing that moves the market is traders expectation. Most of you are heard about sentiment. Yeah, what's the market sentiment? Most of you go on baby pips to see the market sentiment. Yes, it works for a lot of people. Gold has been bullish for a while now, and then same with Bitcoin too. So a lot of people are going to be bullish on these pairs. So if you check your baby pips or whatever, you're going to see it's market sentiment for so pairs is bullish and all that. It's strong or it's weak. When it's weak, it predicts a sell off. That means traders are expecting the commodity or such currency pair to dump. Okay, let's say this for example. Let's say we are going to have a release of CPI data, and what we expect, the forecast that we are having is lower than the actual, or maybe okay, it's lower than the previous, not actual, because now these are expectations, not things that have come into realization yet. Let's say we are expecting CPI data to be released, and then the forecast is lower than the previous. You will see the dollar will start selling. Dollar will be bearish even before the data is released. You see dollar trading downwards until something happens otherwise, which is what we are going to talk about now. When bank release their statement, financial informations, let's say the expectation was bearish and all of a sudden the CPI data is released and it is higher than the forecast and higher than the previous, you are going to see a switch. Let's say market was bearish all this while, market has been bearish, you're going to see a switch. Market is going to switch all the way up, become bullish, and a lot of pips will be covered in just a short period of time, because this was not actually expected and market just seemed to take everybody on an impromptu. So market is going to be very, very volatile. Market will be so volatile, to be fast. The move will be fast. Thousands and hundreds of pips done in 20 minutes or 30 minutes. So that is another thing that moves the market. Then finally, we are going to talk about the big guy in the room, liquidity. Yes, liquidity. A lot of people seem to misunderstand what liquidity truly is. So let me explain this. Liquidity are those points that price seems to target. Yes, points in price that price comes to stop out traders, stop hands. Yes, stop hands for traders. So you could see this zone, and mostly liquidity are always resistance levels, support levels, and all that. Now take a clear look at this. This is the support level. Sorry, yeah, resistance level. And right here you see a support, building support right here. Now you see price came straight down. Price went up first leg, took out buy side, took out the sell side liquidity, took out the buy side liquidity, moved to its direction. You can see what price did there. Buy side liquidity and sell side liquidity taken out. That's liquidity in the form of a range. Now there's another liquidity that's in form of double bottoms and double tops. Let me see if I can find any around here. Let me see if I can find any around here. We have liquidity as double top and double bottoms. We have liquidity as of all-time highs. Yes, all-time high liquidity. You can see here all-time high liquidity. Let's just take a look at this one. All-time high liquidity is okay. Let's take a look at this one. I think it should be around here. Yes, all-time high liquidities. Let's say recent, or we could say recent high liquidities. Let's say right here, this is the previous high, and at this point market has changed direction. Remember when we were talking about market structure, we said something like markets changing structure. This was the last high, so market from this high sold down, took out this, sold down here, took out this high, reversed, then went up again, breaking the structure. That means market has shifted structure to the bullish upside. So right here now, what we have here is a what we have here is a bullish structure. Yeah, market now have changed structure, and you can also see that here to market made the same moves. Market made the same moves here. You see the structure shifted here too. Structure shifted here to the upside. So this range here, you could see this range here. Market has just been choppy, no real direction, no real trend. Markets always seem to take out all this. That's a bunch of liquidity. And when you see candle spikes like this, long spikes like this, market seems to always come back to take them out. And then we have this too. We have this too. Price change leg here. Price change leg here. Little retracement. Push to the downside. Leading to a break of structures right here. We are trying to mark out different types of liquidity, taking out all those lows. So this here is like a double top. Yeah, multiple double tops. This here is like a double top or a resistance level. Resistance and double top is almost the same thing. And we have this two repeating itself here. You could see that market came in here, took all of them out. it wiped out all of this, clean from here, took all of them out, and then we had a dump to take out this order low. That's what I was saying. We had a dump. Price did not really take it out there, so price reversed, and then we had pushed to the downside from this other leg of price. You can see price finally took out these equal bottoms too. That was another point of liquidity. That price was out wanting, you see. So big sellers, big buyers, the big boys in the industry, the bank, they always want to buy from a preferred zone. They always want to buy lower and sell off higher to make more profit. So those points that have multiple stop hands and a lot of resistance stacked up, a lot of orders stacked up in the market, those areas are going to be their areas of focus. Yes, they are going to be watching out for those areas. They want to sell off from there, they want to buy from there. They literally want to take almost all their trades from there so that they can take you out and then they will be in the game. That's just the fun of it. So that's almost everything about liquidity. Yeah, everything you need as a beginner. Just understand that. And then we have the last type of liquidity I'd like to talk about. That is session high and session low liquidity, or daily high and low liquidity. Most people call it CRT for the daily high and low liquidity. And let me check. I don't know if I'll be able to cover everything in this video, but let's try. Let's try and see what we can do. Okay, now this is a daily candle. This is a daily candle. This is a daily candle. You can see literally that. Let's use this one. You can see this one right here. When I say daily high and low, this was the previous day high, previous day low. Price came here, previous day high, previous day low. These are like types of liquidity I'm talking about. These are types of liquidity. So price came here, price came down here. If you check the lower time frames, you see this. See price doing something like this, then start moving in uptrend direction to take out this other high, this daily high right here, this daily high right here. Let's check our 15-minute time frame and see what we got right there. Our 15-minute, what do we have? What do we have? What do we have? 15-minute, what do we have? You see what we have on 15-minute, right? See what we have on the 15 minutes. What we have on the 15 minutes. Price closed here, came back, took out the low of that day, swept liquidity here. All these backed up orders, swept it, pushed to the upside, change in structure, give a retracement. You can see the market literally did this before market pushed down here. You can see that market was choppy all along this range. Market was choppy here. That means that's a bunch of accumulated orders. People are trading lower time frames like 1 minute. They're going to be buying and selling in between this. So market takes them out from the buy side, takes them out from the sell side, comes back here and start buying off after taking them out from both sides. You can see the market takes them out from both sides, comes back in and starts buying off. So yeah, that's just the beauty of it. There's the daily liquidity. Then we have the session liquidity. Let me show you guys what I use for my session liquidity. I use my indicators because I don't really mark the. I just search trading sessions. trading sessions. It's easier this way. Trading sessions. I already have one I'm using here, so add it to chart. Indicator added to chart. You can see that this is the trading session, and let me clean this off. Let me take this off the screen. You can see market always comes for it. Market always comes for it. The blue one right here is the Asian or Tokyo session. This one right here is Asian session. This is the Asian low. You can see the Asian low was taken out here. Price took out Asian low there. Price took out Asian high. This is Asian high. Price took it out. That's number one. You come back here. Almost same thing is happening. Almost same thing keeps happening. Taking out session highs. Not be session highs here. And then coming right back here to take out session lows. Mostly happens to the Asian session. You can see it here. So price takes out the session high. Takes out that session high. It took out the session low here. Just right there. It took out the session low. So these are just types of liquidity. And you notice one thing. Once price takes out, like when it took out the session low, it ran quick up into the session high. So you just need to understand how these things work. Once price takes out session high or session low, it just moves to the next target immediately, like without waste of time. It just goes to the next target immediately. So that is just all about what moves the market and why the market moves. Market is literally hunting your stop loss. Yes, market is coming after you, so you have to be very smart to be a profitable trader. See you guys in the next video.